The concept of indemnity is best illustrated by
Would it be A?
is A.
Yeah.
Yep. Yep. So first thing you want to identify here is what is indemnity? Indemnity is, or indemnification, right, is getting the insured back to the same financial position they were in prior to suffering a loss, right? So the concept of indemnity is replacing a 10-year-old television with the same one, right? Just getting them back to the same position they were in previously, right? Just replacing the same TV. That would be indemnity. In auto insurance, insurable interest must exist at which of the following times?
I'm thinking C.
C.
C. Yep. So remember with insurable interest, again, first thing we want to identify is what is insurable interest. That is that you have to be in a position where you're going to lose something financially in the event of a loss, right? So examples I used yesterday was I can't think my neighbor's house is going to fall apart any minute and go and take out an insurance policy on him. I can't do that, right? Because I won't lose anything financially. So that's insurable interest. Why must it be present specifically in auto insurance at the time of application as well as the time of loss? Is if you sell your car, right? If you sell your car to Bobby today and he gets into a car accident 2 weeks from now, you don't lose anything financially, right? So that's why it has to be present at both times. Insurance is designed to provide protection against which of the following types of risk?
B.
Yeah.
Yep, B, exactly. And what's the other type of risk? There's pure and there's what?
Speculative.
Speculative, exactly. And what's speculative?
Potential risk
Yep, meaning what? There's a chance of,
of not losing.
yep, gain,
Or gaining.
right? You can gain something, exactly. Yep. So they're your only two types of risk, right? So that's a kind of pointer for the exam, right? So if you can identify from the answer choices, there's going to be throwaway choices, right? Every answer has four options, right? So if there's something where there's only two, you have a 50-50 shot, right? Your only options here are pure or speculative. They're the only two types of risk, right? So pure means there's no chance of gaining anything. Speculative, there is a chance of gaining. So the only type of risk that is insurable is pure. Farmer John's barn was destroyed when a tornado blew down one of its walls. The wall knocked over a lantern, causing a fire that burned down the entire barn. The proximate cause of loss was
Would be A, right? The tornado.
the tornado. Yep, exactly. So what I would say here, especially when they give you scenarios like this, and this is a good example of what you'll see on the exam, is they give you a lot of kind of longer scenario-based questions. So they're giving you a lot of information here. You'll hear me say 1,000 times. Get down to the core of what they're asking, right? So really that last part is key. The proximate cause of loss, right? That's the question. So what is the proximate cause? Remember, proximate correlate with primary, right? PR, proximate primary. What's the first thing? What's the primary thing that happened? The tornado. The principle of indemnity is designed to avoid,
B.
yep, to avoid overpayment, right? So again, indemnity is get the insured back to the same financial position, right? Never overpay. It's to get them back to the same financial position. The primary responsibility of an insurance company is to, so as you're reading through these, some of these may sound like they could be the right answer. With these, you want to pick the most concrete, like the most undeniable answer.
D.
D. Yeah.
D, yep. And this is exactly why the exam is tricky, because B sounds like it could be right? Provide the insured with a safety program to help modify losses. Inspect the insured's property on a regular basis. That's part of what the insurance company can do. Provide inventory sheets to the insured along with the policy. Like all those things sound like they could be correct, but it's asking what is the primary responsibility, right? And this kind of ties back to the definition of insurance, right, that we talked about yesterday. We're all familiar with insurance, right? We probably all have it in some capacity, but the definition of insurance, right, is a contract that binds the insurer to indemnify the insured, right? The whole purpose is to pay the claims under the policy, right? Get the insured back to that same financial position, right? So what's the primary responsibility? Pay the claims. You guys are starting to get a feel for why the exam is tricky, because it's questions like this. Not even questions, it's answers like this. They put a lot of answer choices in there that are similar. Frank sold his car to Jill, but did not cancel his auto insurance policy. Jill had an accident 1 month later, and Frank reported the accident to his insurance company. Frank was not able to collect money for damages to the car. even though his policy was still in force because,
Would it be D as in dog?
That's
yep,
what I'm
D,
thinking.
he no longer had that insurable interest, right? And again, this is another perfect example. A sounds like it could be right? Frank didn't drive the car. It sounds like it could be the right answer, right? And that's, again, like a lot of what the exam writers will try to do to you. They're going to put things in there that are obvious. Like there's one when we get to commercial, it's called contingent liability, which is protection for contractors. And in the in the answer choices, they're going to say contractor's liability. That's the most obvious answer, right? Contractor's liability. A is the most obvious answer, right? But don't fall for those obvious answers. You want to go for what the term actually is, right? That term is insurable interest, right? Frank will not lose anything financially because Jill got into the accident. Which of the following is not an example of insurable interest? As you're reading through these, there's one kind of keyword here in one of these answer choices that makes it incorrect, right? It makes it that he doesn't have he or she does not have insurable interest.
A.
A, yeah. What's that word that makes it that he or she doesn't have insurable interest?
I guess told him that they've left it to him in a will.
Exactly. Yep. They just told him, right? They haven't done it yet. They just said, we will, right? Eventually do it. They haven't done it. So he does not have insurable interest yet.